Welcome back to our conversation on financial reporting. In this session, we will try to understand some corporate decisions and their impact on the financial statements. And today's focus is the capital reduction decision of Reliance Retail. Recently, the Reliance Retail has announced that there will be a reduction of capital by Reliance Retail from the existing non-promoter shareholder. On July 7th, the board of directors of Reliance Retail approved the capital reduction decision. And that is the focus of our discussion today. So the company has decided that the shareholders, other than the promoters and the holding company, the shares will be bought back or extinguished to that extent. So upon that reduction, the shares held by these minority shareholders shall be cancelled and extinguished. And that is called capital reduction. There is a price attached to that also. The price that the company has agreed to pay to the minority shareholder is 1,362 per share. So in this session, we will try to understand what is this capital reduction and the entire exercise of the Reliance Retail. So, but before we do that, let us understand the ownership structure of Reliance Retail. So the Reliance Retail Limited is a subsidiary of Reliance Retail Venture Limited. And Reliance Retail Venture Limited is a subsidiary of Reliance Industries. Reliance Industries holds 85.06% shares in RRVL, and RRVL holds around 99.93% shares in RRL. So in Reliance Retail, RRVL holds 99.93%, and the other minority shareholder, let us give a name to them as minority shareholder, is 0.07%, so less than 1%. Approximately, these shareholders hold around 34 lakh shares, approximately. So the focus of the capital reduction is 34 lakhs. The focus of the buyers or the sellers of the shares will be these minority shareholders. And so the capital reduction is about 0.07%, which amounts to about 34 lakh shares. So to recap, so RRL, Reliance Retail, has decided to reduce capital to the extent of 34 lakh shares. In the process, post-capital reduction, RRVL will hold 100% stake in RRL. So RRL will continue to be the major shareholder of RRVL, and RRVL will become 100% parent, or RRL become 100% subsidiary of RRVL. So what is this capital reduction? As we have seen the notice, the public notice given there, it says it is a capital reduction, not buyback of shares. There is a difference between buyback of shares and capital reduction. So the capital reduction is governed by Section 66 of the Companies Act. The notice also says that they're adopting capital reduction through the route of Section 66 of the Companies Act. The Section 66 primarily discusses the steps for a company to reduce the capital and provide all disclosures to that effect. But it's important to note the reduction of share capital will be unlawful unless it is sanctioned by National Company Law Tribunal. This is the difference, Buyback doesn't require this sanction by the NCLT. Buyback has its own conditions. Reduction has its own, capital reduction has its own conditions. So therefore, these are two different sections. The legal formalities of capital reduction under Section 66 and buyback under the Companies Act are different. Though both end, the consequence is the reduction of capital. According to Section 66, a company limited by shares or limited by guarantee by a special resolution can reduce the shares. But they have to explain why they want to reduce. But it is Section 66 says a capital reduction will not be allowed, shall not be made if the company is in arrears in repayment of any deposits. That means to protect the outsiders, to protect the creditors. So capital reduction is regulated to protect the interests of the creditors also. Capital reduction can be done different ways. Capital reduction can be done by extinguishing with respect to the unpaid capital. Suppose the capital has not been fully paid, then unpaid capital will say that the shareholder is not required to pay to that extent. Or the capital reduction can happen by cancelling the paid up capital, which is in excess of the needs of the capital, or paying off any paid up capital which is in excess. So in the third case, paying off, cash is paid off to the shareholders. And that is a route which Reliance Retail is adopting. So what is the capital reduction for Reliance Retail? They're paying off the paid up share capital to the minority shareholders. The moment you say paid off, then the question comes is, what will be the price of the shares? Since Reliance Retail shares are not listed, so there is no price in principle. Hence, the valuation was determined on the basis of a recommendation by two independent registered valuers. And their registered valuers are Ernst & Young Merchant Banking Services and another valuer, BDO Valuation Advisory. So that means RRL took the services of these two firms to value RRL and then fix a price. So these two companies, these two merchant bankers arrived at two different prices per share, 884 by E&Y, and BDO came with 849 per share. This is the valuation exercise done by these two valuers. This is the price recommended. But what is the price that Reliance Retail has agreed to pay to the existing minority shareholder? 1,362 per share. The price suggested by the advisors in the range of 850 to 880. But the price given is 1,362. So therefore, the newspapers and others say that Reliance Retail is giving a premium to the valuation. But despite that, the shareholders are unhappy. That's what they say. The minority shareholders are unhappy with this price. Why? So therefore, that brings us to the unlisted companies market, which we call gray market. Let us see what is happening in the gray market. If you see in the gray market, the shares are also traded in a gray market. So one of these sites where I could lay my hands on, it says the price is in 2022, slightly outdated, 3,200 per share. That means somebody is buying and selling the shares in a gray market, and that was being traded at 3,200. So different sites are there. You can have a look at it. So the price is 2,400 to 3,200. So it's, remember, somebody might have purchased the shares at 3,200. Somebody might have purchased the shares in the gray market at 2,500. Obviously, for them, this 1,362 is a loss. So therefore, there's a big chunk of the minority shareholders who are not happy with the price. But is the company doing any injustice? Okay, that is what any advisor should look into. So 1,362 is a price per share that Reliance Retail is going to give to this 34 lakh shares. So cash outflow from RRL, not from RRVL, not from RIL, but from RRL. The cash flow will be 1,362 into 34 lakh. Is a cash outflow. So when we say that the capital reduction always affects the financial statements, in this case, it will affect the financial statements of RRL. Before we understand that effect, let us take a hypothetical example. So for this company, the total number of shares available on their balance sheet on this day is 10,000. Promoters are holding 9,900 shares, and others, let us call them minority shareholder, 100. So the company is planning to reduce the capital to the extent of 100 shares, exactly like RRL. The exit price is 60. This is the company's balance sheet. At this juncture, we are not getting into any other transaction. Assume that it is going to happen immediately. So what will happen to the financial statements? In other words, what is the effect of the capital reduction on the financial statements of RRL? Let us understand through the lens of X Limited. So when 100 shares are paid off, okay, our capital is reduced to the extent of 100 share, then when the company is required to pay 100 into 60, 6,000. Cash outflow will be 6,000. Let us see that. So after the transaction, cash reduces from 75 to 69. You see that? Cash reduced from 75 to 69. Why did the cash reduce? Because of the capital reduction. What is that capital reduction consists of? 6,000, which is excess money paid over the face value, okay, 5,000, and towards the face value, 1,000. Capital reduced to the extent of the face value, and the balance I adjusted to the reserves. So capital reduction affects the cash flows, affects capital, affects the reserves. In the process, will affect the equity of the company. All other things remaining constant, the equity of the company falls because there is a capital reduction. But because the capital falls, because the number of shares fall, the equity falls, the book value per share will also change. Book value is the equity per share. In this case, the book value has come down. 35 has become 34.7. Why did it fall? Because the price that the company has given, 60, is higher than the book value per share, 35. If the price would have been lower, then the book value may go up. We don't know about the price. I can't talk about the price. Price depends on many situations. For example, in case of Reliance Retail, they fix 1,362. So what is the effect of the capital reduction on financial statement? It affects cash flows, and that cash flow is a cash from financing decisions. And it reduces capital, and there's a corresponding reduction in the reserves. As a result, corresponding reduction in the equity, and change in the book value per share. I'll just say change in the book value. So that is one aspect of. The another reason why the shareholders may be unhappy with the price, not only the price that Reliance Retail is quoting is below the price prevailing in the gray market. Gray market has its own limitations, but still, for an investor, there's a market, right? They bought 3,500. If somebody is going to sell it at 1,362, there's a big loss for him or her. Besides that, there's a tax implication for the shareholder. Since the shareholder is receiving some form of income, there is bound to be a liability to pay tax. The shareholder is receiving money. So if the shareholder is receiving money, Income Tax Act becomes applicable. So taxation is an Income Tax Act. Balance sheet is a Companies Act and accounting standard. So Income Tax Act section 222 has defined a term called deemed dividend. And therefore, it says any distribution by a company on the reduction of capital to the extent the company has accumulated profits, that will be treated as a deemed dividend. So the Reliance Retail is a profit-making company. There's a huge amount of accumulated profits on the balance sheet. The significant part of 1,362 will be treated as a deemed dividend in the hands of the receiver. So the shareholder is unhappy because the price they're getting is less than the gray market price. And plus there is a dividend, deemed dividend part of it will be treated as a deemed dividend. And any excess above that will be treated as, also capital gain. So there are two taxes there, two types of income coming under the definition of taxable income under the Income Tax Act. And there's a classic judgment of Supreme Court that any reduction of share capital will result in deemed dividend and capital gain. So therefore, a shareholder of RRL is unhappy because the price is lower than the gray market, because the money received is will be in the hands of the receiver is taxable. So do they have an option of not accepting? No. So it is mandatory. That means you're bound to take it. Unlike the buyback. Buybacks to a large extent is a voluntary nature. I may or may not surrender. But here it will be cancelled. So capital reduction of Reliance will become like this, opposed capital. What next? The scenario will be like this. RRL will hold the majority stake, of course, continue to hold RRVL, and RRVL will be 100% holding company of RRL. So why did the company do this? This is a $1 million question for all of us. Now, we don't have an answer, but the speculation in the market is maybe in future, RRL may go to become a listed company, or RRVL will become the listed company. What will be RIL's decision? So press is saying both. So we have to keep a watch on what is going to happen to RRVL and RRL. Which one will be? So in principle, there is the informal sources in the news and others shows that the listing will happen through RRVL, not RRL. Now then, what will be the purpose of having RRL as a separate? Maybe over a period of time, it will get merged with RRVL. We don't know that. So, or maybe something else which is not visible to an ordinary shareholder is behind this driving this strategy. But it's of course it's worth keeping a watch on these three players: RIL, RRVL, and RRL. Retail is one of the big chunks of the RIL's business. The other one is, of course, the Geo. So in our next discussions, we will see what is RIL trying to do with the geo. So one of the important corporate decisions, therefore, of the recent past taken by RIL is the capital reduction. So RIL is actually doing a lot of corporate restructuring, and one of the corporate restructuring in the recent times is the capital reduction of RRL. In the process, RRL becomes 100% subsidiary of RRVL. Thank you very much.